US dollar to Japanese yen is testing the 157 level today, marking a significant retracement of the gains made following recent currency interventions. Market participants are on high alert as reports of rate checks from major dealing desks begin to circulate. This move suggests that the market is once again testing the Ministry of Finance's tolerance for yen weakness. We will examine the drivers behind this move and the potential for official action. Before today's move, the yen had seen a period of volatile stability following two suspected rounds of intervention near the 160 and 158 levels. Positioning had temporarily lightened as traders feared further Ministry of Finance action. However, the fundamental pressure of the US-Japan yield gap remains the dominant force. With US Treasury yields remaining sticky and the Bank of Japan maintaining a cautious pace for rate hikes, the path of least resistance has once again turned toward yen weakness. Markets entered today's session expecting a test of previous resistance, but the speed of the climb toward 157 caught several desks off guard, leading to a scramble for cover in the spot market. Today's primary catalyst was a series of reports from Asia and Europe-based dealing desks indicating that the Bank of Japan has begun rate checks with liquidity providers. This is often a precursor to direct intervention. In tandem, Governor Kazuo Ueda was appointed as the chair of the Committee on the Global Financial System at the Bank for International Settlements. While a two-year appointment, this elevates the Bank of Japan's voice in global policy divergence debates and suggests Ueda may feel more emboldened to address currency-induced inflation. Meanwhile, idiosyncratic risks like the quality fraud investigation at Nikkei and stalled US-Iran talks have added a layer of caution to the broader Nikkei 225 rally, preventing exporters from fully capitalizing on the weaker currency due to rising geopolitical and governance concerns. Analysis from Tokyo-based desks highlights a growing sense of urgency. Yuto Heika, an FX dealer at Traders Securities, noted that US dollar to Japanese yen is nearing a full unwind at the 157 level. He observed that while Asia and Europe desks are actively checking rates, some caution remains regarding the return of US political figures like Scott Bessent to the spotlight, which could shift dollar sentiment. Other Tokyo strategists suggest that the 157.80 level is the critical line in the sand where jawboning from the Ministry of Finance will likely transition into physical yen buying. The consensus among local dealers is that the market is essentially daring the authorities to step in again, despite the high cost of repeated interventions. The move to 157 propagates through several channels. For US dollar to Japanese yen traders, it's a game of chicken with the Ministry of Finance. For the Nikkei 225, a weaker yen typically supports exporter earnings, yet we are seeing a decoupling as importers face surging costs. JGB yields are also sensitive. Any hint that the BOJ will use a rate hike to support the yen could lead to a sharp steepening of the yield curve. If the Ministry of Finance intervenes, we expect a rapid, multi-yen drop in the pair, which could trigger a temporary sell-off in Japanese banks as the market reprices the urgency of Bank of Japan policy normalization. Volatility is currently the primary export of the yen market. The Japanese financial press, led by the Nikkei, is focusing heavily on the record influx of foreign capital. Overseas investors reportedly bought a record 5.6 trillion yen of Japanese stocks in April, surpassing the peaks seen during the Abenomics era. This massive flow creates a paradox. While global investors are bullish on Japanese equities, the sheer volume of these trades often involves yen selling or hedging, which further weakens the currency. Local outlets are also reporting on the internal pressures at companies like Nikkei, where over 1,000 cases of suspected quality fraud are being linked to intense performance pressure. This suggests that the Japan premium is being tested by both macro and micro factors simultaneously. Positioning data suggests that leveraged accounts have started rebuilding yen shorts after the initial shock of the April interventions. Real money flows remain mixed, but the massive 5.6 trillion yen equity buy-in suggests that many funds are choosing to remain unhedged or are actively using the yen as a funding currency for the carry trade. Retail margin traders in Japan have been seen bottom fishing for the yen, but as 157 is breached, there is a rising risk of stop-loss orders being triggered. This could create a vacuum that pushes the pair toward 160 unless the Ministry of Finance provides a credible deterrent. The government pension investment funds movements are also being monitored for any shift in foreign asset allocation. Looking ahead, the 157.80 level is the immediate technical hurdle. Beyond that, the 160 psychological barrier looms large. Traders should monitor the schedule of Vice Minister Masato Kanda and Finance Minister Shinichi Suzuki for any escalation in rhetoric. Key data points include upcoming U.S. inflation figures, which will determine if the Fed-BOJ divergence will narrow or widen further. Additionally, the Bank of Japan's next policy meeting will be scrutinized for hints of a reduced bond buying program, which could serve as a stealth tightening measure to support the yen without a formal rate hike. Finally, keep an eye on NIDEX earnings and governance updates as a proxy for broader corporate sentiment. We see three primary scenarios for the coming week. In our hawkish scenario, the Ministry of Finance conducts a massive intervention above 157.8, driving the pair back toward 152 in a flash move aimed at punishing speculators. This would likely cause a temporary dip in the Nikkei. In our baseline scenario, the authorities stick to verbal warnings, allowing US dollar to Japanese yen to drift toward 158 while they wait for US data to cool the dollar naturally. This maintains current equity momentum but increases import inflation. In the dovish scenario, the Ministry of Finance remains silent, and the Bank of Japan avoids hawkish signaling. This would likely embolden traders to push US dollar to Japanese yen back to 160, forcing a much larger and more expensive intervention later. Each path carries significant risk for carry trade participants. To wrap up, first, US dollar to Japanese yen is at the 157 threshold, a level where rate checks have historically signaled imminent action. Second, record foreign buying of Japanese stocks is providing a floor for equities but contributing to yen selling pressure. Third, watch for 157.80 as the immediate trigger point for volatility. Stay positioned for sudden moves and high-frequency jawboning from Tokyo officials. Subscribe to Tokyo Macro for your daily briefing on the forces moving Japan's markets.